Welcome back to Squawk Box on CNBC, live from the NASDAQ market site in Times Square. A few stocks that we're going to watch or that you may want to know about as we count down to the opening bell. Computer printer and maker HP Inc. has adopted a poison pill. The move was made to fend off a hostile takeover bid from Xerox. Organic grocer Sprouts Farmers Market reported quarterly profit of 27 cents a share. That was nearly double the estimate. The company also issued an upbeat earnings outlook. And poultry producer Pilgrim's Pride. Wow. Poultry producer Pilgrim's Pride.
Well done.
Thank you. Alliterative.
Peter Piper.
Peter Piper. Anyway, fell 10 cents short of estimates with quarterly earnings of 14 cents a share. Pilgrim's Pride pointed to difficult conditions in some key markets. Most of those, they have no idea. Mexico.
She sells seashells by the seashore.
No, but the alliteration, they didn't know they did that.
No, it's clever. Performed well.
Good.
Last hour, we were joined by St. Louis Fed President Jim Bullard, who spoke about the strength of the U.S. economy.
I've been arguing that we're in good shape for a soft landing in the U.S. economy. Tracking estimates of GDP in the first quarter hanging right around 2%, 2.25%, something like that. So that sounds to me like, at least as far as the assessment that we can make as of today, we're not going to see a major impact on the U.S.
To continue the conversation about the Fed, we are joined on set by Steve Liesman and a special guest. Steve, welcome back.
Thanks, Becky. We are pleased to be joined by the Atlanta Fed President Raphael Bostic. President Bostic, thanks for joining us.
It's great to be here.
Let's start right in with the issue of the day, which is, can you tell us how you're thinking about the potential effects of the coronavirus on the U.S. economy?
Well, the coronavirus, one of the issues we have is that new information comes in all the time. And so we know it's going to be disruptive to China, to production, to a lot of the supply chain. When I talk to businesses here, what they tell me is that it's going to be a short-run disruption if you have that kind of exposure, but they're not expecting that they're going to lay off folks. They're not expecting that there'll be an extended negative impact. And so I think this is going to be like a short-time hit. We'll get the economy back to its usual level that Jim was talking about, 2.25%, sometime into the future.
So does that mean you're looking at some points coming off of GDP in the first quarter, but getting most of that back in the second quarter?
That's what my models are saying right now.
Right.
But of course, we get new information about coronavirus pretty much every day. And so while we have that as our baseline, we're always open and monitoring to make sure that there aren't new things that are coming up that have some deeper implications for the economy.
I'm not quite sure how to ask this, but when you fold that scenario into the coronavirus, what's your general outlook for the U.S. economy? So
that's sort of an unclear question. So let me say my general outlook for the economy is pretty good. We're going to be at 2.25%. Employment is going to continue to be strong. Inflation is not going to be a significant problem. And when I look around and talk to business leaders and folks and consumers, the one thing I hear is, we're not taking extra risks. We're not seeing anything that would lead to significant changes in course. And as long as that's going on, I think the economy can just roll along as it has been.
And is policy then right, or to use the term of art you guys have been using, appropriate for that scenario where it is right now?
Yeah, I have no impulses really to think that we need to do anything with our policy stance different than where we are today.
So then how do you fold into that the idea that the market has priced in a probability of a rate cut?
So that's into the future, right? And, there are many different scenarios about what's going to happen between now and, say, June or July. My baseline expectations are that the economy is not going to see burgeoning risks and it's going to stay stable, so we won't have to do anything. But my focus is really on today and what we know today, what we know next week as the data comes in. If we see more weakness than expected, then I'd be open to moving, but that's not my expectation.
But what's not in the future, President Bostic, is where bond markets are right now. You are toying with all-time lows on things like the 30-year and the 10-year. What signal is that sending you?
So it's sending me a couple of signals. So one, we know that just there's a global impact of global rates are low, right? So our neutral rate of interest is much lower than it has been historically, and that's pulling everything down. I think there's also issues around flight to safety. So the United States is a place where capital is flowing, and that's actually pulling down yields as well. The other thing that I see when I look at these yield curve shapes is really trying to find risk. I talk to our finance guys at the bank, and they say, well, the yield curve's got the shape that it has, and I say, so where's the risk? Where's the switch that's going to happen such that the economy is then going to turn in a different way? And when I ask that question, I'm not getting a lot of clarity. So we're going to continue to ask, we're going to continue to look, because ultimately we're going to have a change in the economic performance from decisions that happen by people in the C-suites all across the country.
It's well to point out that the Atlanta Fed is not a small-time regulator when it comes to banks, right? There's a lot of banks that are located there now, right? Aren't you guys on the front lines of supervisory when it comes to...
We have a lot of banks.
Right.
Our district has, we have a couple large banks. So we have like Regions Bank.
Right.
We used to have SunTrust, which just moved into the North Carolina district, or the Richmond district, because of Truist. But we have a ton of community banks. And so in a lot of the smaller towns across the Southeast, there'll be that baseline family-owned, long-standing financial institution that plays a critical role. And so we talk to a lot of bankers, and they're also not taking on excessive risk. And so things are pretty solid, and I'm pretty comfortable about where we are.
What about the liquidity that's been injected by the Federal Reserve into the equity market, into the banking system? I jumped the gun on that. Has it had an effect, do you think, in pumping up the stock market?
I don't think so. Now, we've had a fair number of conversations about this at our team. And, one thing that we see is that there has been this correlation. But correlation doesn't always equal causation, and there are a lot of other things that are happening as well. And so, when we think about trying to identify this explicitly, the real question is, can you tease out all of the other stuff to make it clear that it's exclusively on our policy? Now, there may be a little, but I don't think it's the main driver.
If it's not the liquidity that was injected, I mean, Jim Bullard made the point that if you're really looking to blame the Fed, look at the 3 rate cuts from last year, driving rates down across the board. Is that something that pushed a lot of money towards equities because there's no alternative and there's no yield anywhere?
So that's possible. Again, there's a lot of things that are going on to drive this. If you look at what's happening in the equity market, there's a lot of index investing that's happening. There's a lot of movement in terms of the technology companies. So there is some justification for it. But it is, I acknowledge that it's...
Maybe you're doing what you're supposed to be doing. That is managing the economy in an effective way for growth. So you averted some type of... Maybe it was too tight. Maybe there was going to be a bump in the road. You averted that. Business stayed strong. Companies continued hiring. Stock market went up. So it was the Fed. It's not just the liquidity, but it's that you're managing the economy in an effective way.
So there may be some of that. One thing I would say is that, given that where policy stands right now, we're very close to what we call the effective lower bound, or zero, right? And so when you have that kind of limited space, I think there is some advantage to being a bit more stimulative than you might be otherwise. So what you're saying, I actually don't have that much of a problem with, but I think it really is around... I was
trying to tell you that you guys are helping and control... I'm giving you more credit than I like to give the Fed, because I wish it was the underlying economy, but at least you're out of the way.
So I do think it's the underlying economy, but I think it's because we're out of the way, right? Okay. So, one of the things that I've always thought, kind of where we stand right now, is that the economy is strong. It can stand on its own feet, and it can grow pretty consistently. And so we should let it do that.
You raised the point about how there is a lot more indexing that's taking place, investors putting their money into the broad indexes. Does that raise a concern for you? I mean, you've noted that it's happening. Does it matter?
I'm not concerned with these things right now. I mean, one of the things that is really important is just to understand the patterns. And so we're doing that. And then once you understand the patterns, the next thing is to really have our team think, like, what are the implications for this? Does this really affect how we should think about what's going to happen in the economy?
Have you found any answers to that? Because, I mean, it's an interesting point. We're going to be sitting down with Warren Buffett on Monday, and he's been a huge advocate of investors just putting their money into the indexes. But are there unexpected or unintended consequences that could come from that?
It's potential. So, I've read a couple of articles that talk about the concentration of a small number of companies that run these index firms, these index funds, and that could lead to some more coordinated strategies into the marketplace. But right now, we don't see that. So, it's still something you got to keep an eye on. But right now, I'm not seeing anything that would suggest that.